I work and have my real estate license at A Better Way Realty. So you can find me on LinkedIn at under John Wells Realtor. That's Jon Wells Realtor. And on there, you'll see my freebies and videos that are helpful, for people that are interested in group home investing, or if you're an operator, looking to, gain the access to funding, for those types of programs, then we can help you, start your program and get the right backing through grants and things like that. So I've got some freebies there for both the group homes and also for investing in syndication. So the do's and don'ts of syndication investing.
Every professional dreams of freedom, not from their calling, but from financial constraint. In Blueprints for Passive Prosperity, discover how disciplined strategy, smart leverage, and purpose-driven investing can replace active income with consistent cash flow. Learn how today's most strategic investors are trading burnout for balance and spreadsheets for serenity. Welcome to Streams to Impact, brought to you by Steve Talker Capital. I'm your host, Dr. Alan Lomax. If you've built success, but your money still works harder for the IRS than for you, it is time to change the blueprint. Here we explore how to harness secure, high-yield assets that build wealth without adding another job to your life. Before we begin, claim your free access to the Great Tax Escape. The private presentation reveals how high-income professionals legally redirect taxes into appreciating income-producing assets. So go to thegreattaxescape.org and start keeping more of what you earn. Once again, that is thegreattaxescape.org. Now let's dive into today's conversation with Blueprints for Passive Prosperity. Just a brief disclaimer, all information shared on Streams to Impact is for educational purposes only and not to be construed as financial, legal, or tax advice. Our guest today, John Wells, is a Colorado native with over 25 years in real estate sales and investing. With an MBA and certification in negotiations and investor strategy, he's guided countless clients toward lasting financial independence. Managing a $5 million portfolio that includes purpose-driven group homes, John proves that profit and impact can ride in the same direction. Today, he's helping investors reallocate into commercial syndications that deliver 3 to 5x equity growth without adding another job to their lives. Welcome, John, to Streams to Impact. We are so happy to have you with us today.
Really looking forward to today's session. So, John, let's get into the program with looking at today's environment. And why do you believe that group homes and syndications are still really one of the smartest places to put our money?
Great question, Dr. Allen. So I've been doing the group home dance for, about 7 or 8 years now. And when I got into the first group home, I just felt like the whole burden of dealing with tenants, was lifted. When you have a business renting your property, they treat it differently than a residential tenant. They take on a lot of responsibility. So, you can kind of attribute to something similar to a triple net lease in the commercial world, but you've got, in my case, a residential property. So I think the seamlessness with group homes is great. Syndications, if you find the right team, and I hear that you do a lot of vetting of syndications yourself, and I'd love to learn more about it. But I think if you find the right team, I think you can de-risk, the investment. And if you find the quality, in the GP team, then I think you're doing well. And I'd love to know some of your criteria, honestly, of how to vet GP teams. But I think the returns are a lot better than in regular residential real estate.
Absolutely, and they're certainly more stable and less volatile than the residential market can certainly be. So in terms of the group homes, so you're saying this is like a triple net. So you are so I guess you own the home, and then the company who is providing services for the group home is your client rather than you actually running the business itself. Is that what I understand there?
Yeah, that's correct. I do know the business. I've seen a little bit of that side of the business in owning a subsidiary company that was involved with treatment of people going through alcohol and drug addiction recovery. So
Mm-hmm.
I saw that part of it. So I understand the operational side, and I think, thank God, I'm not on the operational side. To collect rent and try to manage the clientele.
Mm-hmm.
Um, and I look at it. I think my probably my best similarity would be to compare it to a multifamily property, with brand new renters, that may have had a life changing event, that they were kind of in the middle of overcoming. So people in transition is pretty much where the group homes serve. That's their clientele, and it's a great service. I just can't imagine the operational side of it. The operators that I talk to are very humble. They don't complain because a lot of them have gone through addiction recovery, and they're in recovery. My favorite operator is 10 years in recovery with him and his wife, and they never complain. They just keep getting people sober. So it works.
Well, group homes, I guess, could come in all sorts of flavors. The groups that I guess you work with mostly are addiction recovery. But there could be, I suppose, senior living homes. There could be homes for individuals with various different kinds of psychological and mental health issues as well. Have you had anything outside of the addiction recovery homes?
Yeah, so we'll service anybody. Getting into group homes, our main investor, my main investor is my office. So our office has an investment division, and we purchased assisted living specifically and have 1,000 beds, not under management, but we have 1,000 beds under landlord type of management. So I learned from the owner of the company, and he's been my mentor for 15 years. So I sort of started, followed in his footsteps, and I've acquired 5 group homes. And one of
Mm-hmm.
them is a licensed mental health home. So it's different than the sobriety play. I kind of chose to play a little bit small. Don't think I regret it yet because the asset hasn't changed from a
Mm-hmm.
residential property. So you still get the residential appreciation. You still have a single family home that you can sell when you're ready to. And you haven't converted it, via a lot of add-ons, commercial type things like, fire alarms and sprinkler systems and things like that really don't help a property sell. So
Mm-hmm.
I think playing small in this arena was smart. So I kind of get the benefit of having the cash flow and the upside in the end. The program that we do offer a lot of operators is a lease to own scenario. So if they were to renovate and convert it into a commercial property, then they have the business that then qualifies to take the landlord out in the end,
Mm-hmm.
and acquire the property. So that's a neat program that we offer that community, and we do range from on the low end of the spectrum, 6 bed uh, group home to 100 bed assisted living. So kind of all everything in between.
Yeah. So, when does it move from a single family designation to commercial property? Is it a bed limit or how,
Yeah, that's a
what
good
is that
question.
program?
In Colorado, the number I believe is 16 beds. So
Oh,
we had originally started with 8 bed locations, 8 and 10 licensed beds, and then ratcheted up to a 16 bed by adding a garage, by taking a large garage and converting it to living space. A lot of that happens. And so going from, I think it was originally going to be licensed for 8 to 10, we took it up to 16 And I think that was double occupancy. So 16, that's a good question. I know that in Colorado, 16 beds and more is a commercial property. And other jurisdictions are going to arrange, anything from probably 15 beds and higher. Then you go from a residential to commercial.
So, yeah, it depends on the jurisdiction. Probably, I'm guessing not just state, but county regulations could come into that.
I think so. Yeah, I think so. It is all fair housing protected. And even though it is, we've had run in, kind of done headbutts with HOAs and tried to overcome our disagreements with them. And they would lose in a court of Supreme Court, justice, but they would, give you a really hard time and make you spend a lot of money on legal bills to take them there. So a lot of times we will succumb to, places that don't want us there and either sell the property to the HOA like we did in one case, because they just didn't want us in their neighborhood, which was very discriminating, but they got away with it. So.
Yeah, HOAs can certainly be that way.
Yeah.
Well, John, in comparison of stocks versus private real estate or private equity, what makes cash flow investments really more attractive in this market? I mean, the last few years have been really quite good for the stock market. And it keeps surprising me how well the stock market does when everybody knows the underlying value just really isn't there. So why is it that private equity, private deals still are cash flowing better than the stock market?
Well, I think you've answered it just in the question. Stock investments, crypto investments, they're not really designed other than maybe some dividends, to create the cash flow. And so really you have to, when you're either getting ready to retire on a lower asset value, you have to really search around to give yourself a higher return. The stock is just too volatile and it doesn't really give cash. It doesn't spin off cash like a rental property or an income property does. So I just think they're two different animals. I think a good investor will have a little bit of both and hopefully more heavily invested in the income property so they can replace their income first. And then maybe they have, their gambling money to go into the stock market because who knows when that next event's going to take the market down 30%, and then you can't really get to your nest egg very easily when the assets are down. So I do think there's value to both, but I do think they're just completely different animals. I like the predictability of cash flow investments, whether it's a rental property or whether it's just an income play. I like to invest in hard money funds right now. It's a little scary because of the market, but I think the real estate market's going to rebound. I think it's already taken a bit of a hit, so hopefully it doesn't go much lower.
Well, I certainly feel much better with tangible hard assets myself, and it isn't just cash flow that is the difference there. You can't depreciate stocks and bonds. You can't use them as tax liability write-offs. They don't appreciate; they just fluctuate with with whatever is happening in the market. So there's just a lot of things that I don't like certainly about it, and so I basically stay away from the stocks and bond markets as well. So, John, you have, like myself, you have lived through the 2008 downturn. And I suspect because of that experience of going through that, there was a lot of things that you do differently now today than what you did prior to that. At least that certainly is my story. And so just what are some of the things that you refuse to do today that you may have done prior to 2008?
Well, I was pretty early in my real estate career in the early 2000s. I think my first fix and flip attempt was in 2005. That turned out to be a bit of a flop, and so I ended up renting that. So that was probably my first long term rental or so back in '05. Um, but what I don't do, prior to, or what I was doing prior to, I just speculate. I think you can speculate with a small amount of money, but if you speculate with your entire, retirement account, I think you're playing with fire. You don't want to gamble, and I think that's what's great about what you're doing is you're showing people. I assume you're showing people how to not gamble away their retirement and their nest egg. And protecting your assets. So I think I've learned, through thick and thin that, you just be as conservative as you can when you're talking about retirement account money. Um, I don't know if that answered your question or not.
Yeah. Well, yeah. I mean, that's certainly what we attempt to do. And yes, we write extremely. We underwrite very conservatively. I know that doesn't mean a whole lot because whoever you talk to out there tells you that they're underwriting conservatively. So that's kind of an overused term for sure, but we really mean it, and I expect you do too. And I think those of us who have been through the 2008 crash realize the importance of that aspect of being sure that our estimates or that our pro formas are conservative, because if the market goes the other way and things go up, we're only going to benefit from that conservative underwriting. If the markets go down, then that conservative underwriting does protect our interests and the interests of our investors there. You had mentioned earlier the aspects of there's a lot of operators out there, and there certainly are, and there definitely are not all created equal. And you ask what are the things that we go through? Well, we have really about we have a 53 item process that we go through in our due diligence process before we even get to underwriting. So, what are some of the main red flags that stick out to you when you are looking at a team to possibly invest with?
That's a really good question. I'm fairly new as an LP, really looking for deals that are outside of my wheelhouse, and so I have learned to look for experience first, and make sure that the sponsor level has been around for a long time, and they have a track record and they have some exits in the asset class that they are promoting, and that it's not a new asset class to them. I have a number of operators and partnerships that I'm looking at investing in, and I think it's difficult right now because of the fact that multifamily is just kind of scary, with inflation, and how do you raise rents with such high inflation? And when they pivot, it's a really smart thing right now. But then if they're pivoting into a new asset class they don't have a track record on, then what do you do? Do you trust them? Are they going to perform well? Will they, bring on a new team member to show the way, to a successful exit? So I think experience is probably number one, and then transparency and communication is definitely one that I think if you can't get information up front, you need to run. And if you hopefully are networking with, the syndication partners before you invest, hopefully you have gained a lot of trust and you see how they communicate and find out what the cadence of their communication is, and you're interacting with them. I had a few members, in this networking group that I frequent. They just volunteer, for the sponsor and really get to see the inside and out of the company itself. So they see that they're doing what they're saying they're doing, not just talking. and not just, giving you a front to believe or something like that. So I think that's good. I think meeting the CEOs in person is really critical. I've been doing that in the hard money fund that I invest in. And I think when you do that, you're developing a certain level of trust. And then you really see what kind of person they are. And I think you are investing in a person ultimately, not just a product. I mean, I think they say that a bad operator can ruin a great investment. And then a great operator can turn around a horrible property. So you are investing in a team. So meet the team, get to know them. I'm going to go on an internal audit of the hard money fund that I'm investing in first quarter of the year, just so I understand what they're up to. They're younger, so it's a little scary. They're younger CEOs, but I'm getting to the point where I would like to think about retiring, and having a young, guy with a long path ahead of him is great. So, so I think, so that level is very critical. And financials, the financials. I've asked for financials from a number of operator GP teams that I've been vetting, and they put up a lot of smoke screens and they dodge the question, and I think that's a huge red flag. And then the underwriting, I think underwriting is another huge piece of the financial background of the deal. So if you can't understand the underwriting and have your underwriting match theirs, or you come to a fair understanding of what they're trying to do and the business plan and behind it, what they're trying to do, it just has to be clear and understandable, and not leave you with a whole bunch of doubt in the end. I think that's where your intuition needs to come into play.
Yeah, and I thank you for sharing that, because those are the top items on our due diligence list, and they are all extraordinarily critical. And that is where people oftentimes do get in trouble. They might check out their track records. They are talking to them and they're acting like they're transparent. And so they just go from there and thinking that they are. But there is a huge difference between talking and then actually coming forward with the financials, and then being able for ourselves to underwrite that, which we always do. And it surprises me the number of times we really run into roadblocks when we go from, we're very transparent, we share everything, and then when we start asking them to document that, it oftentimes is a very different story. Thank you for emphasizing that, because our audience can't hear that enough. So, John, what big economic signals do you personally watch when you decide when to deploy capital versus to sit tight? Is it interest rates, regulations, demographics, international scene? What's the big deciding factor there?
Yeah, I remember that question, and I believe that all of it's important. And so when you're getting into, say, a group home, that regulation environment is always changing depending on maybe who's in the presidential seat. What's the monetary policy? Are they cutting back special interest programs, or are they funding those things left and right? So I know that there are essential programs. So I look at regulatory environment as a main key piece, especially when you're investing in a group home. But right now, with interest rates kind of, what I would hope is kind of a peak, we're talking about cutting interest rates. I would hope that now is a good time to enter because prices are lower. And if they drop price, then values start to increase, and the cap rates compress and instead of expand like they have been doing. So I think all of it matters some. As far as the priority goes, I like to see liquidity in the market. I think that was something I wanted to mention earlier. As far as what I don't do is I don't over leverage, but you also want to know that banks are going to lend, when you need the money. and that you're not kind of backed into a corner without a paddle, going down the river without a paddle. You need those resources. And I think that's really the only reason why the multifamily market just got so unattractive is, it's all about interest rates and kind of it wasn't that they went out of control, because going up to, lending rate of 7% or so, that wasn't that bad. But when you came from 3.5%, to 7.5% in 18 months, that's a pretty big problem. And everything was underwritten at those lower rates. Nobody saw it coming. So yeah, I think it was difficult for a lot of operators to overcome that. And, that's a big piece. Monetary policy is huge. And just understanding, what's going on in the local market. Real estate, they always say, is not really the real estate market. It's the local market. And the market can kind of save you. So if you're investing in the right area, population growth, job growth is going to generate higher values. And so even a poor entry, the market may save you in the end of the day. So there is appreciation. Don't bet on it. But if you need to get lucky, then you'll probably do better if you vetted the location. So I look at the macros first, and then dive into the micro, the property, and the income and the cash flows. So I like underwriting. I can kind of do it because I've been doing this type of business for so long. I don't dwell on the underwriting. So I think maybe somebody else might be a better underwriter than I am on a team. But I do see how critical it is, and how liquidity is key to success. So it does need to produce a profit, monthly profit. Otherwise, you're kind of swimming uphill.
Yeah. The markets are going to go up and down. And like you mentioned, it wasn't that interest rates are so high. The 6 and 7% interest rates are really historically much more common than the 3 to 5. But it was that 18-month jump in there. And of course, the operators who were the ones who were hurt by that, you had talked about track record to begin with there. Well, the more experienced operators have come through this without being hurt, because they know that these kinds of things can happen and they're prepared for them. But there, of course, were a lot of new operators from 2015 through 2022. I mean, everyone was investing in multifamily housing, and there were a lot of people who thought that interest rates were going to stay at 3.5% for the rest of their lives. And they learned some hard lessons, like you and I learned back in 2008. So it's always, of course, really important to look at that. All of those different things. In terms of, I just had a question for you here. In terms of when we're looking at multifamily properties, we're really looking at the finances in terms of the cash flow that is coming into those properties, and is that viable, and so on and so forth. Well, when you are doing the group homes, you're purchasing single family homes which don't have an income basis to go on. So you are looking at comps as compared to financial data there. Is that correct?
Well, not really. That's really the beauty of the group home is that you are counting on an income, from their business. It's really about the operator. In my scenario with the group homes, I mean, you might buy a vacant group home, and unlicensed vacant group homes that need to become licensed can take a year to get licensed through the different bodies, governing bodies that provide those licenses. So that's a year of no income. So there's your scenario where you don't have any income. But if you're buying an income property that's producing already, an assisted living or a mental health location, and they have a track record, you're buying an income. I think the main difference is you as a landlord are renting to one tenant, and your one single tenant is the operator, as opposed to a bunch of tenants where you have, insulation from the concentration of only having one operator and one check that you're collecting every month. So you're going to vet that operator like you would a general partnership syndication. So that's the hat that I wear. I started off as a mortgage broker in the 2000 time frame, or 1995 to 2000. So I have that background where I can dive into finances and then understand a balance sheet and see liquidity, and so that's what I really refer to when it comes down to an operator, plus their experience, and hopefully it's not their first time. Otherwise, I would be running. So I think you do have an income, but it's just more of a single income stream as opposed to many incomes, that you have in syndication, other types of syndications.
So in that scenario, you really are purchasing a business. I was just thinking that you were probably purchasing single-family homes and converting them, but you primarily are purchasing existing group homes, which that makes a lot more sense to me than actually buying the vacant property and converting it. I'm wondering if you do buy a property that is not a group home, does it have to be vacant through that time period that it is becoming a licensed property, or could you put a single family family?
It's really difficult because a lot of the requirements in order to become licensed, they're tearing up the place, and I don't think a party could live in there, while they're adding a sprinkler system. Basically the few scenarios that I've seen where we go from a regular residential to an operating licensed facility, they're funded a lot of times by the government, because they need housing. They need these things called step down locations from hospitals and mental institutions. They need to take those people out of those very expensive situations for, probably for the government. A lot of these are not considered wards of the state, but they're individuals that don't have the ability to pay rent, and they don't have the ability to pay their medical bills. So, they're about as close to becoming wards of the state, and so they don't want to keep them in hospitals or very expensive institutions. So they hire operators like I work with to basically convert a single family home, so it's comfortable for them and they can stay there long term. And they will pay for the upgrades, and they will subsidize the income if they need to keep people, in the housing and get them off the streets. So I see large mansions getting converted into group homes that are licensed, through that process.
Yeah. Well, it sounds like a very interesting business. Well, let's just take a moment, John, if you would, and just tell our viewers and listeners about your company. And you have a couple of gifts that you are giving away. If you would tell us what those gifts are as well.
Sure. So I founded A Better Way Investments, and I work and have my real estate license at A Better Way Realty. So you can find me on LinkedIn at under John Wells Realtor. That's Jon Wells Realtor. And on there, you'll see my freebies and videos that are helpful, for people that are interested in group home investing, or if you're an operator, looking to, gain the access to funding, for those types of programs, and we can help you, start your program and get the right backing through grants and things like that. So I've got some freebies there for both the group homes and also for investing in syndication. So the do's and don'ts of syndication investing. So, please check it out. And if there's questions, I'm happy to hop on a call and see if you are interested.
And all of that information will be in our show notes as well. Well, Jonathan, if you had to rebuild from zero starting today in this exact market, what 3 moves would you make first, and why would you make those?
Yeah, that's a great question. And it's something that I would hate to have to go through, first of all. I don't think anybody likes to start from ground zero. But I see a lot of, gurus and, talking about starting from zero and getting dropped off in the big city with, a bag of, groceries and starting from scratch and creating $1 million portfolio overnight, and so I think networking is really critical. And in what I have discovered over the last 12 months of learning about syndication investing and diving a little bit deeper into trusting other people with my money, is that there are people out there that are doing it better than I could. And so networking is going to be key. And then along those lines is finding partners that can see the value that you bring, and then bring them value and maybe volunteer to, help build their program or their product. And so those are the two things, is networking and finding capital. And the third thing, I would just find something that you're passionate about. Because, if you're not passionate, you're not going to get up in the morning and be excited. So find something you're excited about, and everything else should fall into place, I think.
Yeah, good recommendations there. And I like what you said there about there are people out there who can do a lot of things better than you can do. Well, likewise with me. And actually, that's why I ended up really focusing upon sourcing and capital raising. I initially, when going into commercial real estate, I was going to do the whole thing myself. I'm been a realtor for a long time myself, and so it's not like I don't know how to do these things. But when I really started looking out there and looking at where I am age-wise, I'm going, gosh, there's people out there who are established, who've had a lot more experience than I have, and it would be somewhat ludicrous for me to just go out there and try to compete against them. Plus, in networking, I can work with them rather than competing against them. So excellent advice there, John, and I appreciate you sharing that. So you have helped a lot of active landlords actually retire themselves by reallocating into passive deals. How do you do that, and why is that shift especially important in today's environment?
Well, I do think that, I don't think you need to recreate the wheel, when you're talking about single family investing or even, commercial syndication investing. But the key difference is you're either an active landlord and you're taking those midnight phone calls and you're going out and fixing things either on your own or you're hiring, other people to do that. And there's just no real, peace of mind. So I think it's a lifestyle thing. If you want to have peace of mind, and you want to have passive income, then you need to probably take the shift of, from being an active landlord into doing something different, with those assets. And it's a trust thing. It's scary, and you need to get to know those people. But I think it's most important when you're getting ready to retire and you want to start to enjoy your time, buying your time back through those types of investments and finding the truly passive investment income is going to be critical to get there.
Absolutely. Yeah.
If today's episode inspired you to design your own path to financial freedom, you can connect with John Wells on LinkedIn at linkedin.com/in/John Wells Realtor, where you'll find his free guides, syndications, do's and don'ts, and group home investing 101. What a powerful conversation with John Wells, a clear reminder that prosperity doesn't come from working harder, but from structuring your wealth to work for you. To keep your wealth running free and unbridled, watch The Great Tax Escape. The private presentation reveals how high-income professionals legally redirect taxes into appreciating income-producing assets. You can access it free at thegreattaxescape.org. Until next time, keep your wealth running strong, your purpose clear, and your impact unstoppable. I'm Dr. Allen, and this is Streams to Impact.
Thank you for tuning into Streams to Impact, brought to you by Steed Talker Capital, a company empowering passionate professionals like you to develop multiple streams of passive income built on solid passive real estate investments. As a significant part of our endeavors to make a cosmic and meaningful impact for this world, Steed Talker Capital contributes significant portions of our profits to activities and organizations committed to better understanding the equine. These endeavors attempt to enhance the treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures great and small flourish abundantly. If you are ready to learn how our passive investors have earned an average 33% annual return on their investments, schedule your complimentary passive income to Prideful Impact consultation. Obviously, we cannot continue indefinitely to offer these valuable consultations for free, so grab your passive income to Prideful Impact consultation while you still can. Go to steedtalker.com passive